Hello everyone, welcome back to another video lectures. Today we're going to continue discussing chapter 10. Right, so last time we stopped here, today we're going to pick up where we left off from last video. So in the last video we already talked about the major methods to depreciate personal properties and real properties. Right. Today we're going to start off our lectures with a few exception cases. And then we're going to move on to discuss amortization as well as depletion. All right, and then we're going to finish off chapter 10 today. All right, first let's talk about exceptional cases of depreciation. Right, so besides the maker's system, Congress have designed some other program that help taxpayers to kind of like to incentivize taxpayers to invest in their business. So I want you to introduce the first program, which is the Section 179 expensing program. So Section 179 is the part of the Tax Cut and Jobs Act. That is passed in 2017. Right? So this section basically is allow taxpayers to immediately expense the cost of acquiring tangible assets for up to $1,020,000. Right, and it's optional. If taxpayers want to select this, they have the option to select the tangible asset, right? And then the maximum amount of expensing is $1,020,000, right? And taxpayers can choose different assets that they put in place, that they place into service during the year to apply this expense. For example, if in 1 year, this year, let's say, a company put into service 3 assets, a house, a building, a car, and a machine, right? So the taxpayers can choose among the 3 items, the 3 assets that are placed into services this year to apply the expenses, right? And then the maximum amount of immediate expense can be $1,020,000, which is a lot, right? However, there's a phase-out system applied to this program as well. So the phase-out is $1 for $1 if the amount of tangible assets that are placed into service during the year exceeds $2,550,000. Right. So if the company put more than the total amount of tax basis of the assets that are put into service during the year is more than $2,550,000. The expense going to be the allowable number of expense going to be it's going to be decreased, right? And then it's going to be totally phased out if the total number of assets, the total number of the total tax basis of the asset exceeds $3,570,000, because this is the $1 for $1 phase out rate. So if the value of the assets that are put into service during the year exceeds these numbers, then there's no expensing allowed for the taxpayers, right? So and then besides that, there also are some other limitation in terms of for applying the immediate expensing program. So first of all, let's talk about the taxable income limitation. Right. So under this limitation, the expense cannot create the 179 expense cannot create or extend the business operating loss. Right. So what does that mean? It means that if after apply the immediate expense and somehow the net income of the company become negative, right? They create a loss, then that's not allowable for the taxpayers to do such thing. Right? They can only they can only apply the immediate expense to the point of $0 for income, basically of no income. Basically, they cannot commit a loss, right? So that is one of the limitation on the immediate expensing program, right? And then in terms of how to apply the immediate expensing program, taxpayers really need to be careful in terms of which item of asset that they want to apply this expense program, right? So the rule of thumb generally is that taxpayers should choose the asset that has the lowest first year cost recovery percentage to immediately expense, right? Because as we know, if the asset have lowest first year cost recovery percentage, that means the current deductions is going to be lower, right? It's going to be low for that asset, right? So that's why we should just expand it immediately, to choose the asset to expand immediately, right? To create a larger amount of deduction, right? So that's the rule of thumb, right? So let's look at this example. Hopefully it's gonna make it a little bit clearer for you guys to understand about this program, right? So let's look at this case. So this company, they acquire and put into service 3 assets during the year, right? So they have a computers and information system which costs $920,000, and they put into service on March 3rd. They also have a delivery truck which costs $80,000, and they put the truck into service on May 26th. And they also acquired a machine, and they put the machine into service on August 15th, and the machine costs $1,200,000. All right. So in this case, in the example, we say that the company choose to immediately deduct $800,000 of the 179 expense against the basis of the machinery, which is this one. So they pick this one to deduct, right? To immediately expense this amount, right? And they say, note that Titan could have elected to deduct up to $1,220,000, right? Meaning that they can apply the maximum amount, no phase out, right? But they only choose to deduct $800,000. All right. And why is that, right? Well, I mean, maybe they don't want to have a lot of expenses, maybe they still want to have a little bit income, so that's why they don't want to expand the whole allowable amount, right? Maybe they care about the investors' reaction, because investor maybe going to react badly if the firm have a loss, right? So that's why maybe they only apply $800,000 here, right? So the question asks us what the amount of Titan current year depreciation deduction, including regular makers depreciation and the 179 expense on the machinery, right? So here's how we do it, right? So because the firm chose to apply the 179 expense immediately expense on the machinery, right? So first we solve the machinery first, right? So for the machinery, the question we asked for the machinery anyway, so yeah, so we only solve for the depreciation for the machinery, right? But first, right, now we have to apply the deduction amount, right? So the basis of the machinery was $1,200,000, right? So then the firm elect to deduct $800,000 from off the basis, right? So we deduct $800,000 off the $1,200,000 amount here. So now the remaining basis of the machine is going to be $400,000, right? And then from here we're going to apply the regular makers method that we have covered in the previous video, right? So the machine has a recovery period is of 7 years. So we just go to the I'm not going to go to the table, but here they already provide us with the rate, right? So the rate is 14.29%. So we take the $400,000 times 14.29%, and we get the maker's amount, right? And then we have to add back the $800,000 that are already deducted from the basis here, right? And that's going to be our $800,000. That's going to be the total. That's going to be our total depreciation on the machinery, right? Because we can expand this part. We can expand this piece of the leftover depreciation, right? Plus the immediate expense in $800,000, right? So we add those two back, and that's given 857,160, right? So yeah, so that's how we apply the immediate expense in the 179, the item, the section 179 immediate expense to calculate the depreciation. So this is one of the exceptional case, right? In this case, this company, the ALEC, they choose to deduct immediately $800,000, right? And for other, well, after that, for other items, they can choose, they can still keep the regular makers to depreciate the other two items that they put into service, right? All right. So let's look at another example, right? And then this example is actually one of the homework problems. So I hope they're gonna help you guys to do the homework a little bit, right? All right. So the question says, the problem says AMP Corporation calendar year end has 2019 taxable income of $1,900,000 for purposes of computing 179 expense. And during the year 2019, the company acquired the following asset: a piece of machinery placed into service on September 12th, and the basis for the machine is $1,540,000. Computer equipment put in service on February 10, and the basis is $490,000. And one office building they put into service on April 2nd, and the basis of this building is $605,000. All right. So the question asks, what is the maximum amount of 179 expense AMP may deduct for 2019? AMP is the company. So what's the maximum amount of 179 expense? So you can see the firm has taxable income of $1,900,000. Right. Right. So that means if the firm fully applied the maximum phase out, it's not gonna bring down it's not gonna create a loss for the firm during 2019, right? And the qualified amount of the qualified amount for the 179 expense is also less than the phase out, right? So what is the qualified amount, right? So in here, so section 179 expense only applied to personal properties, right? It doesn't apply to real properties, right? So in here we have two pieces of personal properties, which is the machinery and the computer equipment, right? And then the total amount is going to be $1,540,000 plus $490,000. It's going to be $2,050,000. No, $2,030,000, right? Which is still below the benchmark of $2,550,000, right? So there's no phase out here, right? No phase out in this case, right? So that's why the company in this case can apply the maximum amount of the 179 expense, right? Which is $1,020,000. All right. All right. So that's the first question, and the second question asks, what is the maximum total depreciation, including including section 179 expense, that AMP may deduct in 2019 on the asset placed in service in 2019, assuming no bonus depreciation? All right. So first, right, remember the rule of thumb, right? The rule of thumb is to expand the assets that has the lowest first year rate of depreciation, right? So compare between these two item, right? Machinery and computer equipment. Assuming we try to assuming we already calculate the rate, right? And the rate here they already provide us. So the rate for the machinery for the first year, because it is a 7-year, and in this case, it looks like they're gonna use the half-year convention. Right? So from there, we're gonna be able to find the rate. Right? So here they already provide the rate. So the rate for the machinery is 14.29%, right? And then the rate for the computer equipment is 20%. So based on the rule of thumb, we pick the asset that has the lowest first year rate of depreciation, right? Which is the machinery here. So that's why we're gonna apply the 179 expense on the machinery, right? So the original basis, the basic of the machinery is $1,540,000, right? So after we subtract the 179 expense from there, from the basis, now the new basis of the machinery is going to be $520,000, right? And then we apply the makers to calculate the depreciation deduction for the remaining basis of the machinery, right? Which after calculation we have $74,380 here, right? So because we already apply all of the 179 expense on the machinery, and now for the other equipment, right, the computer, we cannot apply any expense anymore, right? So now we just apply the makers into to calculate the depreciation expense for the computer, right? So here they already provide us with a rate, so we have 20%, right? So we take the basis times 20%, and that gives us $98,000 of depreciation expense for the computer equipment, right? And then for office building, this is a non-residential building that are put into service during 2019, right? So based on that information, we can figure out the rate, right? We figure out which table to use in the rate and what rate to apply, right? So here they already give us the rate, which is 1.819%, right? So we just take the basis times this rate, and that gives us the depreciation expense for the office building, right? And then after that, we have to add back the amount of expense that we already subtract from the machinery, right? So we add all of this depreciation up, all of the depreciation expense up, and also add the $1,020,000 of the 179 expense to that amount as well, right? So in total, we have $1,203,313, right? So remember, we have to add back the numbers, the amount of expense that we already take out from the basis of the machine, right? Remember that step. All right. So because we want to calculate the total expense, right? So because we want to expand on top of whatever depreciation, on top of whatever makers depreciation that we use, we want to expand this much of expenditure as well, right? So that's going to give us to have more deduction, right? So that's why we have to add it back, right? All right. So that was immediate expensing under section 179, right? So besides that, there's another program that allow taxpayers to immediately expense the asset that they put into service during the year, right? So that is bonus depreciation. So the bonus depreciation program has been around for I guess probably around around 20 years, right? And again, similar to the section 179 immediate expensing, the purpose of the bonus depreciation is to stimulate the economy, stimulate the taxpayers to invest more into their business, right? So they allow them a tax break, kind of like a tax rate for them to invest, to acquire more equipment to invest in their business, all right? So this program has been around for quite a while, but the detail of the program in terms of how to apply the program has been changing quite a few times in the past, you know. So recently, under the bonus depreciation program, taxpayers or business owners can immediately expand up to 100% of the asset that they put into service, right? And the asset has to be qualified assets, right? However, this program only valid between September 27th of 2017 and December 31st of 2022. Right? So basically, this program, this 100% immediately expands, only lasts for around like 5 years, right? And then after that, it's gonna gradually disappear. Right. So I want to show you a table of the timeline for this program, right? So usually the bonus expense, the bonus depreciation program is mandatory for qualified businesses, right? So if you qualify, somehow you acquire some asset that are qualified for this program, you have to just expense it, right? Unless you can choose not to apply, right? Then you have to write a statement explaining that you elect to not apply this bonus depreciation program, right? And then you can choose not to immediately expensing. And like I said before, like sometimes business, they don't want to have that big of a expense, right? Because it may hurt their income numbers, right? And for company with lost years, they may not want to deepen the loss numbers, right? Which gonna upset the investors, right? So there are many reasons why firms may not choose to apply the bonus depreciation program, right? But technically, it's mandatory for them if they have qualified assets that are qualified for this program, right? All right, so let's look at this table. So here's what I just talked about, right? So between September 28th of 2017 and December 31st of 2022, the bonus depreciation percentage is 100%, right? But then after that, it's gradually disappearing, right? And then after 2026, right, starting for 2027, there's no bonus depreciation program anymore, right? So, but currently in this year, the bonus depreciation percentage is this 100%, right? And then here's the list of the qualified properties, qualified assets that can be applied in this program, right? So asset or properties that have a regular depreciation life of 20 years or less, or computer software, or water utility properties, or qualified film, television, and live theatrical productions, right? So if the asset meets any of this requirement, any of this criteria, then the taxpayers can choose to use the bonus depreciation program, right? And if you look at the qualified property list here, it's very broad, right? Especially the first item, right? Have a regular depreciation life of 20 years or less, which pretty much can apply to majority of personal properties, right? So again, if the taxpayers want to expand 100% of the program of the cost of the assets, they can do that, right? By applying the bonus depreciation percentage. All right. So let's look at this example, right? So assuming that this company Titan claims bonus depreciation for the eligible personal properties, and here the property that they acquire during the year, right? So a computer information system acquired in March for the cost of $920,000. The delivery truck, which is acquired in May, and the cost basis is $80,000. Machinery acquired in August, cost basis is $1,200,000. Right? And then the recovery period is 5 from ranging from 5 to 7 years, right? So basically, these assets qualify for the bonus depreciation program, right? So in this case, the taxpayers, right, this company can choose to immediately expense all of the costs that they pay to acquire all of these assets, right? So the qualified property is everything, right? All of the three items, right? So the qualified property asset basis the basis of the qualified property is going to be $2,200,000, right? Which is the total amount of cost basis for all the three items here, right? And then times 100% of bonus depreciation rate, and then we have the bonus depreciation, the $2,200,000, right? And then the firm can expense the whole amount, the whole $2,200,000, right? All right. So that was bonus depreciation, you know. So yeah, so I just want to introduce to you the concept of these two programs, you know, the concept of bonus depreciation and the concept of Section 179 immediate expense, you know. So taxpayers can choose to apply either one of them, you know, to maximize their tax deductions, right? So besides makers, they can choose to do this, right? To 100% expensing the cost of acquiring the properties, right? But keep in mind that these two programs only apply to personal properties. All right. So let's continue with our lectures. All right. So let's talk about listed property. So what is listed properties? So listed properties are basically assets that are used for both business and personal purposes. You know? So you know, for small businesses, most of the time they're gonna have a lot of property, a lot of asset that they use both for the business and both for their personal purpose, right? Say like a car. Sometimes you go on a business trip, you drive it. When you go to meet the clients, you drive it. So that's what's for business purpose, right? But then you have to use a car to pick up your kids. Then you use the car for personal purpose, right? So again, in real life, there's a lot of times where the property is used for both personal and business purposes, right? So how do we depreciate those properties, right? So depends on the extent to which the taxpayers use the properties for business purpose or for personal purpose, right? So if the business use of the property is greater than 50% of time, right, then the taxpayer can just use a normal depreciation methods, right? Use applying makers, right? But if the business use of the property is less than or equal to 50%, then the taxpayer have to use the straight line method, right? And keep in mind that the depreciation expense is only allowed for the business portion of the properties, right? So based on the percentage of the usage, then we can calculate. We have to time the depreciation expense, calculate using the makers method by the business use percentage, right? To calculate the deductible amount of depreciation expense for the property, right? So let's look at this example. So say assume that in addition to the asset that Titan purchased in 2019, it also purchased a new digital camera for $4,000 that its employee used for business on weekends, on weekdays, and then on weekends Steve uses the camera for his photography hobby. And since the camera is listed property, Titan must assess the business use percentage to properly calculate its deductible depreciation for the camera. So assuming that Titan determines the business use percentage to be 75%, what is Titan's depreciation deduction on the camera for the year, ignoring bonus depreciation and 179D expensing? Right. So first we just calculate the depreciation using the maker's method like usual, right? So here they already give us the rate, right? But we can totally go back to the table to find the rate, right? So the rate here is 20%. So we apply the basis of the camera, which is $4,000, and then we times it by 20%, and then that gives us $800, right? So that's going to be the full year maker depreciation expense, right? And because 75% of the time this camera is used for business purpose, right? So we times that to 75% as well, and then that gives us $600. So $600 is going to be the depreciation expense for the year, right? And keep in mind that because the business use percentage is 75%, right? So we just use the default maker method right here, right? But if it is less than 75%, then we have to use the straight line method. All right. Right. So I'll just keep this. So I just want to introduce you how to solve the depreciation problems with the listed properties, right? But again, it's just a concept. I just want to introduce you. So I will skip to this. Alright, so this is the part where I always enjoy talking about. Right? So luxury automobiles, so cars, right? So usually, some taxpayers, they chose to buy very expensive cars, right? Even though it may not necessary, right? And keep in mind that the business expense, it has to be ordinary, right? And it has to be it cannot be extravagant, right? However, some taxpayers, some companies, they still chose to buy very expensive cars to use for their business purpose, right? So that's why Congress, they have to set some limits in terms of depreciations to kind of prevent companies to do that, right? Because let's say Toyota Camry and Mercedes S500. I mean, if the purpose of the car is to take the taxpayers from point A to point B, then they can totally use a Toyota Camry to do that, right? So that's why. But if the taxpayers chose to buy the Mercedes S500, then because the value of the car is much higher, right? So the amount of depreciation expense generated every year is going to be very high as well, right? So that gives the taxpayers a lot of deductions, right? So that's why Congress doesn't want taxpayers to do that. They don't want taxpayers to buy such expensive cars, because basically the taxpayer enjoy the expensive car on the expense of Congress, right? Of the IRS, right? So that's why they want to set a limit on the depreciation amount on automobiles, right? So here's a table that kind of gives us the limitation, the automobile depreciation limitations, right? So depending on the year and depending on the year that the car is put into service, depending on the recovery year, then we can figure out the limitation of the automobile, right? So how do we calculate the depreciation amount for the automobile? First, we calculate the regular depreciation using the maker's method, right? Just like usual. And then we compare that to this limits table, right? And whichever amount is smaller, then we use that amount to deduct as the depreciation amount, depreciation expense, right? So that is for normal, ordinary cars, right? However, for luxurious cars, meaning cars that cost more than $50,000, there's a different recovery periods applied to them, right? Because again, the Congress doesn't want taxpayers to take advantage of the depreciations to deduct such a big amount when they buy expensive cars, right? So for cars, if taxpayers still choose to buy expensive cars, right, for luxurious cars, meaning cars that cost more than $50,000, then they have to depreciate the cars for 17 years, right? instead of 5 years, according to the maker's PRS, right? So you can see the recovery period is much longer, right? So however, this rule, right, the definition of luxury cars doesn't apply to vehicles that are weight more than 6,000 pounds, right? So this is one of the loophole, I think, that taxpayers can use to get around, right? So if the cars weigh more than $6,000, then it's not considered as a luxurious car, right? So let's say you buy a Toyota Land Cruiser, which costs more than $80,000, right? But because it's so big, it's a big SUV, it's way more than $6,000. For tax purpose, you don't treat it as a luxurious car, right? Even though it is luxurious, right? So yeah, so it's one of the loophole where I think taxpayers can get around, right? So let's look at this example, right? So here, in this example, they kind of outline the how to depreciate two cars, right? One is a 2020 Honda Civic, and the other one is a 2020 Porsche 911, right? So the Civic costs like less than $20,000, and the Porsche costs around $112,000, based on this version that they're providing us with. So as you can see, even though both of the cars are pretty much do the same thing, well, not exactly the same thing, but if the purpose is to transport the taxpayers from point A to point B, both of the cars probably do the same thing, right? But the Civic is much cheaper, right? So you can see with the Civic, we can apply the usual maker's method, right? Which allow the taxpayers to recover the cost during the 5 years period, right? But for the Porsche, because it's so expensive and it meet the qualification for luxurious cars, now the taxpayers have to depreciate this car for 17 years. Right? So very interesting example, right? But still, taxpayer can kind of get around with the exception of vehicle that weigh more than 600 pounds, right? So I think that's where a lot of people are gonna try to take advantage of. Alright, so that was the end of depreciation. So let's talk about amortization, right? So what's the difference between depreciation and amortization? Probably all of us know, right? So for amortization, it's pretty much a recovery cost method applied only for intangible assets, right? So for intangible assets, a lot of times the business is gonna either generate some intangible asset or acquire some intangible asset, right? So if they have such intangible assets, such as goodwill, patents, trademarks, or even some customer list, for those kind of intangible assets, they have to capitalize the asset as well, right? And then amortize it over the allowable period of time, right? So for amortization, the business is just going to use a straight line method for both financial reporting purpose and for tax purpose, right? So it's much more easier than depreciation, right? Just apply the straight line and that's it, right? And for intangible asset, we can categorize them into four groups, right? For main types. So the first one is what they call Section 197 intangible assets. So this one pretty much include the wide variety of intangible assets, right? So customer lists, patents, trademarks, trade names, goodwill, going concern value, covenant not to compete, right? So on and so forth. So for this type of intangible asset, as you can see, it can include a lot of asset, right? A lot of intangible asset can be categorized under this type, right? And then the second type is the startup expenditures and organizational costs, right? The third type is research and experimentation costs, or sometimes they call research and development costs, right? R&D, right? And the fourth type is patents and copyrights, right? So let's talk about each of this. So The first one is Section 197, intangibles. Right. So for this type of intangible assets, the recovery period is set for 180 months, right? Or if you divide it by 12, so that's going to be equivalent to 15 years, right? So it doesn't matter what the actual life of the intangible asset is. The business have to use 180 months to capture to use as the recovery period. Right? It doesn't matter, even though let's say if the copyright the company has a copyright for 10 years, but still for tax purposes they still have to use 15 years to as their recovery period of the copyright, right? And for this type of purpose, for this type of intangible, the taxpayers can use the full month conventions, right? So pretty much this tax rate can start depreciating the amortizing the intangible asset the first month that they got the intangible asset, right? And they are allowed to amortize it for the full amount of the first month. Right? It's not like it's not half month convention. Right? It is full month convention. So immediately they can start amortizing the asset that they acquired, right? All right. So let's look at this example. So we say, assume that on January 30th, 2018, Titan acquires a competitor's asset for $350,000, and of the $350,000, $125,000 is allocated to tangible asset, and $255,000 is allocated to Section 197 intangible assets. Right? And this is including patent for $25,000, goodwill for $150,000, and a customer list with a 3 years life for $50,000. So for each of the first 3 years, Titan would deduct 1/15 of the basis of each asset as amortization expense. So because for amortization, we can just going to use the straight line method, right? So that's why they use 1/15 for each year. They use 1/15 of the basis as the amortization rate. Right? So the question asks, what is Titan's accumulated amortizations and remaining basis for each of these intangible after 3 years? So they ask us what the amount of accumulated amortization and remaining basis after 3 years. Right. So after 3 years, so to be able to calculate the accumulated amortization, we just use 3 times 1/15, right? Because that's how they calculate the amortization expense, right? So 3 times 1/15, and then times the basis, right? So that's going to give us the accumulated amortization, right? So we have for the patent it's going to be $5,000, for goodwill it's going to be $30,000, and for customer list it's going to be $10,000. And then from there we can calculate the remaining basis, right? So pretty straightforward. Alright, so let's talk about the second type of intangible asset, right? So organizational expenditure and startup costs. So these are usually the costs that taxpayers incur to basically to set up initially set up their businesses, right? So a lot of this costs, even though the startup costs can include some tangible asset, right? But a lot of times the startup costs also include the intangible asset, right? So that's why we can categorize them as one of the type of intangible asset here, right? So for startup costs and for organizational expenditures, we also use the straight line method to amortize the cost, right? And however, there's a exception here, right? There's a rule that allow taxpayers and businesses to immediately expense up to $5,000 of the startup cost, right? And then this amount is going to be phased out if the expenditure exceeds $50,000, right? And then the payout is going to be dollar for dollar, right? So if the expenditure reach $55,000, then there's no immediate expense allowed anymore, right? So let's look at this example. Hopefully it's going to be helpful for you guys to understand this concept, right? So it says, assume Titan is a corporation and it amortizes the $51,000 of organizational expenditures remaining after it immediately expenses $2,000 of the cost, right? And it asks, and it says, if Titan began business on February 1st of year 1, how much total cost recovery expense for the organizational expenditures is Titan able to deduct in year 1, and how much cost recovery expense will Titan be able to deduct in year 2? Right. So first, because this business can still immediately expense some of the expenditure, right? So first we need to take out that amount from the basis, right? So it's a it has $51,000 a basis after it take out the $2,000 of immediately expense, right? So that means the original basis was $53,000, and we take out $2,000 of immediate expense, and that leaves us $51,000 of the adjusted basis, right? And then and then for startup costs, we also use 180 months as the recovery period, right? So from there, we can, using the recovery period, using the straight line method, we can calculate the monthly amortization expense, right? So we just take $51,000 divided by 180, right? And then we times that by the number of months that starting from the first date of the asset, right? So we have 283.33 times 11, and 11 months because the business start on February 1st, right? So that's why we times it by 11. So for first year, the amortization expense is going to be $3,111.17, right? And remember, because we immediately expand this $2,000, so now we have to add it back to the amount of amortization, right? So now after we add it back, we get $5,117, right? So that's the first year. And then in the second year, now the second year is just going to be a full year of depreciation, right? So that's why it's going to be either you take 1/15 times the adjusted basis, right? Or you take 283.33 times 12, right? So that's going to give us 3,400, right? Either way, that's going to give us 3,400, and that's going to be the amortization expense for year 2, right? Because this is a full year, right? All right. So let's talk about the third type of intangible asset, right? So research and experimentation costs. So as you know, like a lot of businesses, right, such as pharmaceutical company, right, they spend a lot of expenditures on research and on developing new drugs, right? For example, for technology company, right, they also spend a lot of costs on a lot of expenditures on developing new products, right? So that's why we have these expenditures, right? So so for these assets, business owners can choose to immediately expense the cost, right? Or they can choose to capitalize the cost and amortize it over the period of time, right? Using the straight line methods, right? So either way, whatever method that generates the highest deduction for the taxpayers, then they can just go with that, right? So regarding the recovery period of this intangible asset, right? So the recovery period is going to be 60 months, right? And it's going to start from the month when the benefits of this R&D or research and experimentation activities start, right? So remember, the recovery period is 60 months here. Right, so it's a little bit different from the other two, right? The other two that we just talked about, the recovery periods were 180 months, right? Here, they will give us 60 months. And then the last type of intangible asset that we covered is patent and copyrights, right? So how we can amortize this depending on the way that the business acquired the patent and the copyright, right? So if the business acquired, right, or purchased the patent or the copyright from someone else, right, then they can amortize the patent or the copyright for the remaining life of the patent or the copyright. So if it is 2 years and if they have 2 years of remaining life left, then they can only amortize for the 2 years remaining, right? If it is 5 years, then they amortize for 5 years. But if the business created the copyright, created the patents themselves, then the recovery period is going to be either the legal life of the patent or the copyright, or the remaining useful life of the patent or the copyright. So whichever shorter, you're going to use that to amortize the assets, right? And again, right, for this intangible asset, we also use the straight line method, right? And just amortize it over the period of time, over the recovery period that are allowed, right? So here in this table, it kind of summarize the characteristic of each intangible asset, right? As well as give us the method that we use, how are we gonna amortize each of these intangible assets, right? So yeah, it's pretty helpful, and you can just use this to kind of review about amortizations, right? All right, so let's talk about depletion, and this is the last part of chapter 10. So depletion, right? Depletion is a recovery method that are used to recover the cost of natural resources, right? So it's only used for natural resources, right? Instead of so compared to so far in the chapter we will talk about depreciation, which we use to recover the cost of either personal properties or real properties, right? And then we should talk about amortizations, which we use to recover the cost of intangible assets. Right? So now this is the last method, depletion, and we use this to recover the cost of natural resources, right? So what's the cost of natural resources, right? Why there's such cost? So there's a lot of times mining or oil and gas companies, they invest in a potential mine, so they can acquire a piece of land, and they're gonna try and estimate how much the resources that they can get out from that mine, right? So in order for them to recover the cost of acquiring the mine or acquiring the piece of land to harvest the resources, we have several methods. We have two methods to help them, right? Two methods of depletion, right? So and the two methods are the cost method or the percentage depletion method. So taxpayer can choose either way, right? There's no requirement for either method, so taxpayer can freely choose between the two methods. So under the cost method, right? So taxpayers, how do they recover? Right? Basically, they have to estimate the number of units that they may get from the mine, right? From the reserve, right? And then allocate the the share of the basis to each of the unit they extract during the year, right? And then once they recover the entire cost, they are not allowed to use that depletion method to recover the cost anymore, right? So let's look at this example. Maybe it's going to help you guys to understand more about this method, right? So the example says Ken's cost basis in the gold is $150,000 that he paid for it, right? So basically, this guy, he bought a gold mine, and then it cost him $150,000 to bought the mine, right? Based on a mining engineer estimate that the gold deposit probably holds 1,000 ounces of gold, right? So basically, the reserve of the mine is 1,000 ounces. Ken determine that his cost. So based on this estimation, Ken can start to determine his cost of depletion. So the question asks, what is Ken cost depletion for the first year, for the second year, assuming that he extract and sell 300 and 700 ounces of gold in year 1 and year 2 respectively. So first of all, we already know the estimate units of reserve, estimate unit of resources in the reserve, right, which is 1,000 ounces of gold, and then we know the cost basis of the whole mine, right, which is $150,000. So now we can calculate the tax basis for each ounces of gold, right, which is $150,000 divided by 1,000 ounces. That gives us $150 for each ounce of gold. Right, so in year 1, it says that this guy sold 300 ounces of gold. So we just take the per ounce tax basis times multiplied by 300, right? And that's going to give us the first year cost of depletion. Right? And then similar thing, right? Similarly, we can calculate the cost of depletion for the second year. So the second year, this guy he sold 700 ounces of gold, right? So we just take the $150, the tax basis per ounce, times 700, and that gives us $105,000, right? So after 2 years, it looked like Ken, right, this guy already recovered all his costs from to acquire this mine, right? So from now on, he cannot use the cost method anymore, right? So starting from third year, he cannot use the cost method anymore, right? All right, so let's talk about the other method. So the percentage depletion method. So this method is basically it is much straightforward, even though the first method is not difficult anyway, right? But the second method, the percentage depletion method, is even more easier, right? So under this method, there's a predetermined percentage of depletion for each type of resources, right? Depending on the type of resources, then there's a predetermined percentage of depletion for that, right, associated with that type of resources. And then you can just times the percentage of depletion by the gross income from the resource extraction, right? And then we get the depletion expense, right? So it's much easier using this method, right? So here's some of the example of the percentage depletion. So for gravel and stone, the percentage depletion is 5%. For asphalt, rock, clay, the percentage is 40%. For gold, copper, oil, and silver, the percentage is 50%, right? So again, depending on the type of the resources, then we can figure out the percentage depletion, right? And then just times the percentage depletion with the income, right? The income generated by harvesting the resources, right? And then we can get the depletion expense, right? So let's look at this example. So this company, they purchased a tract of forest land that it plans to use to harvest trees for the production of paper, right? And then it estimated that the tract contains 30,000 board feet of timber, and the original cost of the property is $75,000, of which $60,000 is allocated to the timber and $15,000 is allocated to the land. So we know, even though the property costs $75,000, the cost of the resources, right, is only $60,000. So that's the basis, right? And we know that the units, the number of units, is 30,000 board feet of timber, right? So with that, we can calculate. If we use the cost method, we can calculate the per unit tax basis of the timber, right, which is $60,000 divided by 30,000 feet, right? So it's $2 per feet, right? And and they say that the companies uses $10,000 board feet during the first year. So it asks how much will they spend under the cost depletion method, right? So we know they use 10,000 feet during the first year, so we just times 10,000 with $2 per feet, right? And that gives us $20,000 of depletion expense, right? So again, really straightforward, right? So that will be the end of our chapters. So again, this chapter, even though it looks complex, even though it looks very lengthy, it's pretty straightforward. You can just apply the method that they outlined here, and you can calculate. You can get either the depreciation expense or amortization expense or the depletion expense, right? So if you practice all these problems multiple times, you will get the idea, right? So all right, so that will be the end of chapter 10. I'll see you in the next video then.